Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Welcome back to the Ask Ralph Show. One of the common complexities I get in my practice is when a taxpayer has rental properties. So I thought I would take some time today and talk about some of the complications that arise when someone has rental properties. And there's a fantastic article here called The Top 10 Tax Deductions for Landlords. And it was written by Stephen Fishman, who is a doctor in law. And basically, the bottom line is if you will take advantage of these tax deductions, a rental property can be a very good thing for you. And it really can make the difference between losing money and earning a profit on a rental property. So let's talk about some of the things that we need to consider. The first one is interest. Interest is often the landlord's biggest single deduction. Now, this includes both mortgage interest, that which you use to acquire the property, and it also includes interest on credit cards for goods and services. So if you use a credit card to pay some real estate expenses for the rental property, those are deductible. The next biggest deduction is depreciation. Now, when you purchase a rental property, you don't get to write it all off in the year that you bought it. You have to do what's called depreciation. Now, if this is a residential rental property, that's deducted over 27 and a half years. So it's a pretty long time. And for non-residential or commercial property, that's over 39 years. So you basically would take the total acquisition price and divide that by either the 27 and a half years or the 39 years. The next area, repairs. The cost of repairs to rental property, that's assuming that these repairs are considered ordinary, necessary, and reasonable in amount, are fully deductible in the year they are incurred. Now, this would include things like repainting, fixing gutters or floors, fixing leaks, plastering, and replacing broken windows. Now, one of the things that we often get into a discussion with my clients about is the difference between a repair and an improvement, or what some people would call a capital improvement. So this is something you're going to want to discuss with your accountant when you're preparing your tax returns, because the way that those are treated are different. So if you make a capital improvement to the property, that has to be depreciated over its useful life versus a repair. Now, a great example of that would be if you repainted your rental property, one could argue that's a repair. That's not necessarily an improvement. So that would be deducted in the year that it happens. However, let's say that you decided to add a room to your rental property. Well, that's certainly not a repair, and that was something that you would write off over the life of the property. Now, one of the things we also need to discuss, and a lot of my clients miss this, and that is local travel. You're entitled as a landlord a tax deduction for driving to your rental property, whether that means to go check on it or go to meet contractors or go to meet a potential a rentor to fill out documents. You just have to make sure you keep track of these things in a mileage log. And then you're able to deduct either your actual expenses, would be your gasoline and repairs and upkeep, or the standard mileage rate, which is published each year by the IRS. Now, if you own a property that is out of state, what we call long distance travel, and you have to stay overnight for your rental property, you also can deduct this. This would include airfare, hotel bills, meals, and other expenses. You just have to make sure that you've got excellent documentation for this. This is something that the IRS auditors put a lot of scrutiny under. So you just have to properly document this and make sure you've got all your receipts in order. The next thing is a home office. Now, I'm not going to talk a lot about home office because it can get really complicated, but you are entitled to a home office if you have a rental property. Even more than that, let's say that you tinker around with your rental property and do some of the repairs and all that yourself. You can also deduct the cost of a workshop or other home workspace you use for the rental property. You also might be able to deduct any storage space that you've got for the rental property. And if you've got any kind of repair items that you're storing for the rental property. Now, another area a lot of people might overlook, and that is if you do any work to the rental property, you're certainly able to deduct the cost to hire someone to perform services. Now, a lot of times I'll get a question about this, and a client will ask me, well, Ralph, can I deduct the cost of me going over and doing the work? And I have to break the news to them, no, you can't do that. Now, you certainly can deduct all of the materials that were used. You can deduct the travel cost, any kind of incidentals, but you cannot deduct your time, which sometimes comes as a surprise to many of my clients when they figure, well, if I paid the plumber $85 an hour, I'll be able to deduct that $85, but I can't deduct my own labor. But unfortunately, that is not a deduction. The next thing, casualty and theft losses. This is talking about if your property is damaged or destroyed from a sudden event like a flood or a fire. You may be able to deduct this as part of a business loss. The next thing you really want to concentrate on, and this is another area that I see a lot of pitfalls, and that's insurance. A lot of my clients will have a personal residence and convert it to a rental property. When they do that, they don't necessarily go out and get a commercial rentor policy to make sure that they're covered. And I am not an attorney, but it's my understanding that a rental property insurance document is different than a residential. So one of the things you're going to want to make sure of is to talk with your insurance agent and make sure that you've got the correct insurance for the rental property. And then once you pay those premiums, you can deduct those as part of the rental expense, and that would be for fire, theft, flood insurance on the rental property, as well as landlord liability insurance. And one of the things a lot of people don't know about is if you buy any sort of extended warranties or home warranties, you can also deduct those. And I've got a lot of clients that have done that because what they tell me is, look, I don't want to be on the hook if something big happens at the house, so I buy like a home warranty that covers me in case there's something, drastic that happens at the house. But it's all about, making sure you've got these things documented. But like I said, getting back to a discussion from a few minutes ago, make sure you've got the right kind of insurance, because I've seen circumstances where someone has converted their personal residence into a rental, and then some casualty happens and the insurance company didn't pay the claim. And that was because there was no commercial renter policy on the books. And the final thing we mention here is legal and professional services. So just like anybody else that's in a business, you can deduct the fees that you pay for attorneys, for accountants, property management companies, real estate investment advisors, and other professionals. These are operating expenses as long as they're related to your rental property. So with a rental property, another thing I get a lot of questions about is, what kind of records do I need to keep? And what I generally tell clients to do is set up a separate bank account for the rental property so that you can run all of your income and expenses through that bank account. You'll find that to be a lot easier. That way you can go back and look at your checkbook, or if you want to get fancy, put it in some sort of software. But you can go back and look at, okay, here's the deposits that I made. Those are my rental income. And you can also look at the expenses. Those will be your rental expenses. Some of my clients might get a credit card just for the rental property and pay all their rental expenses with the credit card. There's a couple of other things I'm not going to spend a lot of time talking about. One is if you rent the property to friends or family, that could potentially be a limit on your losses. And finally, if you have losses in excess of a certain amount, you might lose those in what's called the passive activity loss limitation. I hope this was helpful as we talk about rental properties.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware, and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.